CAPM. Now, in studying CAPM candidates, you are required to get into the background of the theory, the assumptions, beta estimation, the beta coefficient of an individual asset and that of a portfolio, and the interpretation of the result. We are to also cover the security market line model and its applications. Then lastly, we have the conceptual differences between portfolio theory and the capital asset pricing model and the shortcomings of the CAPM. So first of all, we need to understand the background of the theory. Background. The background of CAPM, capital asset pricing model. Now, CAPM, first of all, as I mentioned, is part of the modern portfolio theory. It's part of the modern portfolio theory. Very important. It's part of it. In fact, it builds upon the principles of modern portfolio theory, which was developed by Harry Markowitz. This one was developed by Harry Markowitz. So the CAPM is a cornerstone of modern finance that was developed in early 1960s. You recall we said that the modern portfolio theory was developed in 1950s. Just a decade later, we had this CAPM being developed by several brilliant minds. So building upon the work of Harry Markowitz on portfolio theory, we had these economists who sought to establish a framework that could relate the required rate of return of an investment to its specific risk. So, in studying the background, it is important for us to acknowledge the works of the following economists, the key contributors of the CAPM pricing model: William Chappé, William Chappé. William Chappé is a pivotal figure in the development of CAPM. Okay? He laid the foundation of the model. Another key contributor is Jack Treno. Jack Treno in the 1960s, who was a contemporary of Chappé, also made significant contributions to the development of CAPM, and Treno focused on the beta as a measure of risk. Focused on beta as a measure of risk. Understand? Then we must mention another key contributor of this capital asset pricing model, John Lintner. John Lintner. Again, a contemporary of Jack Traynor. Particularly in 1965. Is it 1965? Yes, in 1965, he developed a paper known as the Evaluation of Risk Assets and the Selection of Risk Investments in Stock Portfolios and Capital Budgets. Then the last figure here is Jan Mosin. Jan Mosin also played a critical role in the development of CAPM. Now, Mosin in 1960 paper, dubbed Equilibrium in a Capital Asset Market, offered a rigorous mathematical treatment of CAPM, further solidifying its theoretical underpinnings. All right, so we have these four figures who built on the work of Harry economist number one, William Chappé, number two, Jack Traynor. We have John Lintner and Jan Mosin. Now, these economists, it's important to note that they were working independently. They worked independently. They were not in collaboration at all. They worked independently, but they arrived at similar conclusions. It's like what I hear most about the writers of the Bible. They were not contemporaries, but their message seems to be the same. Okay, I hope you heard about it in Christian circles, that the writers of the Bible were not contemporaries. In fact, they lived very geographically far apart, and even the eras were different, but their message is kind of similar. The same thing applies with the developers of the capital asset pricing model. They independently worked, but arrived at similar conclusions, and they recognize that investors are risk averse. They recognized that investors are risk averse. Generally, investors are risk averse and seek to maximize returns. That's what they recognize. And even without us reading what they recognize, isn't it not obvious, candidates, that as an investor you would like to maximize returns? Is it not obvious? And this is maximizing returns for a given level of risk. For a given level of risk. That is the determination that they made, though they worked independently. They all agreed on that. So they also understood that not all risk is equal. They understood that not all risk is equal. They understood that not all risk is equal. Some risks, such as those associated with the specific companies or industries, can be diversified away by investing in a well diversified portfolio. However, there could be one type of risk that cannot be diversified away, which is the systematic risk. Not all risks are equal. There are some risks that can be diversified away, others cannot be diversified, particularly the systematic risk. Systematic risk, they recognize that systematic risk, which is a market risk, cannot be diversified. The market-wide risks cannot be diversified. So, because under this risk, this is the risk that affects the entire market, such as economic downturns, or such as political events, geopolitical events, and so on. So the CAPM candidates, the CAPM, the capital asset pricing model, poses that investors should be compensated for taking on systematic risks. Investors should be compensated for taking on systematic risk. So if you are to buy a company from manifested publishers, a stock, if you are to buy manifested publishers share, manifested publishers cannot diversify away systematic risk, because there are certain risks that affect the entire market that the company cannot diversify away. So if an investor was to buy a stock or a share from manifested publishers, then that investor, that shareholder, ought to be compensated for taking on that systematic risk. When you buy a share from manifested publishers, there is a risk that the company's share may go down. So then you have to be compensated for taking that risk, because we know there are certain stocks that are risk-free. Others are not. So CAPM poses that investors should be compensated for taking on systematic risk, and the more systematic an investment has, the more systematic risk an investment has, the higher it is expected to generate more returns. So the more systematic risk an investment has, the higher its expected return should be. That's why we always say the higher the risk, the higher the return. The lower the risk, the lower the return. The risk-free bond or B, the return is always lower, because the risk is zero. And therefore, candidates, therefore, we are building something. Are you following? The CAPM formula. CAPM formula. The relationship is captured in the CAPM formula. Expected return under CAPM is equal to the risk-free rate. Risk-free rate plus the premium, which is the difference between the return from the market minus the risk-free rate times beta. Times beta. Beta times the market risk premium. So the risk-free rate is an investment with zero risk. The theoretical rate of return of an investment with zero risk is often represented by the yield of a government bond, okay, or bill. Then you have beta, which is a measure of an investment sensitivity to market movements. Beta is a measure of risk. And a beta of 1 indicates that the investment moves in line with the market. Beta of 1 beta of 1, if the beta of an investment is 1, indicates that the investment moves in line with the market. Indicates the investment or asset moves in line with the market. But we may have a beta that is greater than 1. Beta that is greater than 1 means the investment is more volatile. So if you have an investment with a beta of 1.2, 1.3, 1.1, anything more than 1, that tells you that that investment is risky. A beta of 1 indicates that the investment moves in line with the market, while a beta greater than 1 suggests higher volatility. And a beta less than 1 indicates lower volatility, lower risk. That's beta. Then you have the market risk premium. Market risk premium, the difference between the return on market minus the risk-free rate. This is the additional return investors expect for taking on the risk of investing in the overall market compared to the risk-free rate. We call the example I gave here, candidates. Investors should be compensated for taking on systematic risk. So this compensation is additional. That's why here we are adding this premium. This is a premium. We are adding it to the risk-free rate, which could be a government bond. The return or yield on a government bond, the beta is 0. Risk is 0. So the expected return constitutes the risk-free rate, this return, which is a return, plus a premium. This premium is the additional return that investors expect for taking on the risk of investing in the overall market compared to the risk-free rate. And you can see, candidates, how the CAPM concept is simple. It is just that simple. That's why it's very popular. The reason why CAPM is popular is because of its simplicity. And the CAPM's elegance and simplicity have made it widely used in finance, because it helps investors assess risk and return characteristics of an individual asset. They can then construct diversified portfolios and make informed decisions. Now, I've explained that this theory is simple. This is the CAPM formula. Now, before we do anything else, I think let's discuss some of the assumptions. Because as simple as it is, and as wide as is being used, it still remains a theoretical model, and it has assumptions which we know may not always hold true in practice, though it remains a valuable tool for understanding the relation between risk and the return in the financial markets. So what are the assumptions? Assumptions. Assumptions of CAPM. Now, CAPM is built on several assumptions. One assumption is that investors are risk averse. Investors are risk averse. This is what all these individuals also agreed about. They recognize that investors are risk averse and seek to maximize returns for a given level of risk. So that's the first assumption. So investors are risk averse. They are utility maximizing. They are not only risk averse, you've seen here that they also seek to maximize return. So they are risk averse, they are utility maximizing, rational individuals. Now in the exam, if you are short of points, you can separate these ones. Investors risk averse, number one, they utilize returns, and they are rational individuals. So investors prefer, under this model, higher returns to lower returns. Investors prefer less risk to more risk. So we are just describing risk averse and utility maximization. So investors prefer higher returns to lower returns. They also prefer less risk to more risk. And investors make rational decisions to maximize their expected utility. That's the first assumption. There is also this assumption that markets are frictionless. Markets are frictionless, devoid of transaction costs. Devoid of transaction costs. Markets are frictionless, devoid of transaction costs, and even taxes, no taxes. This is an assumption. Investors can buy and sell any amount of securities at any time without incurring transaction costs. There are also no taxes on capital gains. There are no taxes on dividends, and investors can borrow and lend at the risk-free rate. That is an assumption. The third assumption is in relation to single holding, meaning that investors plan for the same single holding period. Investors plan and invest for the same single holding period. You can just say single holding period. All investors have the same investment horizon, single holding period. For homogeneous expectations, all investors have homogeneous expectations or beliefs. That is an assumption. All investors have the same expectations about future returns. They have same expectations about the risks of securities. Another assumption of the CAPM is that all investments are infinitely divisible. Infinitely divisible. That's an assumption. That investors can buy or sell any, they can buy and sell any securities, right? Can buy or sell any fraction, let me put it that way. They can buy or sell any fraction of securities, infinitely divisible, any fraction. 6, investors are price takers. Investors are price takers. That will mean that no single investors can influence the market price of a security. So these are assumptions that influence that idealize, let me use that word. These are assumptions that are idealized and may not hold perfectly in the real world. Six assumptions. Rational individuals, no transaction costs or taxes, same investment horizon, single holding period, homogeneous expectations, investments are infinitely divisible, investors are price takers, meaning that no single investor can influence the market price of a security.